Good day, and thank you for joining our industry conversation on climate risk and reporting. I'm Kathleen Birrane, and I serve as the Maryland Insurance Commissioner, and I lead the solvency workstream of the NAIC's Climate and Resilience Task Force. Even before the devastation caused by Hurricane Ian, climate and weather-related risk and resiliency have been a major focus of policymakers this year. And one particular area of focus has been on disclosure requirements, including the NAIC's release of its revised TCFD-aligned climate disclosure survey and the SEC's proposed climate risk disclosure rule. Our discussion today will focus on the intersection of climate risk assessment and analysis and climate risk reporting requirements, and specifically where disclosure requirements are useful and drive meaningful analysis, appropriate action, and the distribution of valuable information, and frankly, where they do not. Our panelists today are each immersed both in the policies and the practicalities of addressing the impact on changing climates and weather on the insurance industry. From the company perspective, we welcome Dr. Kelly Hereye, the Director of Catastrophe R&D at Liberty Mutual in the Corporate Enterprise Risk Management Group and a board member of the International Society of Catastrophe Managers. Dr. Hereye is a certified catastrophe risk management professional and specializes in climate change and emerging risk. From the Hartford, we are joined by Terrence Shields, who serves as the head of corporate law and is the assistant corporate secretary. Mr. Shields currently leads legal teams dedicated to securities and corporate governance, ESG, mergers and acquisitions, and intellectual property. And he recently assumed the role of interim chief sustainability officer, leading the Hartford's Office of Sustainability as it supports ESG strategies, initiatives, governance, and reporting across the enterprise. In addition to our carrier representatives, we welcome Satyam Khanna, who is an independent sustainable finance consultant and the policy fellow at the Stanford Institute for Economic Policy Research. Mr. Khanna joined Stanford after serving as the SEC's senior policy advisor for climate and ESG, the agency's first ever official dedicated to integrating ESG considerations into the federal securities laws. Previously, he was counsel to SEC Commissioner Robert Jackson and served on the staff of the Financial Stability Oversight Council at the U.S. Treasury Department. And from S&P, we welcome Dr. Paul Munday, a director, global climate adaptation and resilience specialist, and lead and coordinator of S&P Global Ratings research and application of climate adaptation and resilience analytics. Dr. Munday works at the interface between data and research, leveraging his expertise to improve clarity of the credit impacts from climate risks. With experience in both the UK and abroad, Dr. Munday advises private and public sector clients across multiple sectors to help mainstream consideration of climate risk and resiliency into projects and programs. So, with that esteemed panel, I think we can get started on what I expect to be a really rich conversation today. So let me start with the broad question of governmental climate risk reporting requirements, or at least in the case of the SEC, proposed reporting requirements, and ask you about the utility and, frankly, the feasibility of some of those requirements. Do these reporting requirements make sense? Do they provide valuable information? Can companies even provide what's requested? And Satyam, let me start with you. Can you give us a short summary of what the SEC is proposing? And then I'd like to hear from the group about how the SEC proposals align with other reporting approaches, such as TCFD, and the practicality and utility of these forms of government reporting.
Of course, and thank you, Kathleen, and I'm delighted to be here. So the SEC proposal broadly contains the following key provisions, and this is at a high level. First, it would create new requirements for the disclosure of climate-related risks and impacts. It would include a requirement to disclose in a company's financial statements certain disaggregated metrics on climate-related impacts. And then third, it would require the disclosure of a company's greenhouse gas emissions, which would include Scope 1, Scope 2, and Scope 3, and for all but the smallest companies, Scope 3 emissions. And just to provide some context, when I was at the SEC, we released a request for information on climate disclosure that helped lay the groundwork for the current proposed rule that you all are familiar with. And what companies and investors said in response to that request is that they are already doing a lot of climate-related disclosures on a voluntary basis, and they encourage the SEC to build on that foundation. So at a high level, and to answer your question, the climate disclosure rule builds on existing market practices. And what the SEC is doing is taking what's out in the market and codifying it in this rule, in particular, the familiar four-part disclosure framework of the TCFD, and for emissions disclosure, the greenhouse gas protocol.
So I'm interested if the companies agree sort of with the assessment that this is building on what companies are already doing, or does it sort of drift into areas that are beyond what companies are doing and maybe what climate scientists might tell us they can be doing?
So maybe I'll start there, because I think there are really two sort of big buckets of particular interest from the insurance side, right? So there's the emissions reporting, which, as you mentioned, some companies are already doing as part of their TCFDs, with traditionally more of the focus on scope 1 and scope 2. Scope 3 remains a challenge, and I think that's true both within the insurance industry and outside of it. But what was particularly interesting to me when I started looking through the SEC reporting requirements was this concept of disclosing physical risk. And this distinction between sort of the mitigation side, what's happening on the emissions side, and the adaptation side, what's happening in the physical risk space, is an area where I think insurance has a real opportunity to show up and have our industry be leaders in sort of framing that discussion, because of the expertise that we bring to the table of decades of experience looking at the extreme events that drive many of our largest physical risk impacts on our economy. So as you mentioned, my background is in catastrophe modeling, which we've been using for roughly 30 years to look at our most extreme events, meaning hurricanes, wildfires, floods, along with non-climate related perils, things like earthquake or terrorism. And one of the things that really struck me about that disclosure requirement is the requirement to disclose physical risk down to the zip code level. And the reason why this was really interesting to me is that this has struck me as a particular challenge in reporting physical risk on the investment side of the house. And this is an area that we've seen pop up as an area of concern, both within the US as well as internationally in reporting requirements, is that typically the information that we have available about our investment books is much more limited in just the physical locations of assets and the characteristics of assets that we would typically include if we were to write them as an insured risk. So for example, in an investment, we might know that it's based in the US, but if we were to write it as an insurer, we would know the locations of every one of their 1,000 retail locations and details about their construction characteristics. And the reason why that's important is that within sort of one country, you're going to have very widely varying physical risks that you're subjected to from climate change. If you're in Miami, you need to think about hurricanes. If you're in California, you don't need to think about hurricanes, you need to think about wildfire. If you're in Minneapolis, maybe you're thinking about flood risk. So the risks that you are subject to vary depending on where you're located, and we don't have that level of granular information today. So from that perspective, just knowing where stuff is a real upgrade. However, I think it's also worth noting that the detail of information that we can pull out from the climate science side down to that level, so on the hazard side specifically, is going to be a real challenge at that granularity of geography. So I recently was at a sort of a strategy workshop with a bunch of different climate scientists who are trying to think about, like, where do we invest our scientific resources to be able to better answer questions that are being posed to us as a scientific community. And I got up in front of that group and I said that we are now being required to report physical risk down to the zip code level. And there was an audible gasp in the room when I said this, because climate models actually work better at sort of large regional scales. That's not to say that we can't pull detailed information out of climate models, but we need to tread really carefully and respect sort of the distribution of uncertainty that those models produce at the spatial scale where reporting is going to be required.
Yeah, and I guess the way I look at it, I'm a securities lawyer by trade, so I focus in on the new rules from a perspective of materiality. And again, I think the SEC made a good decision to align much of its proposal with TCFD. I do think at the center of the debate and likely any litigation that emerges upon the adoption of the rules will be the notion of whether the SEC overreached, right? And the SEC is charged with investor protection. And what does that mean? That means providing material information to investors to inform their decisions, right? And so traditional notions defined in common law of materiality, simply put, is the information important to a reasonable investor in making an investment or a voting decision? And I think there's a really strong argument that how a company manages its climate risk, how it sets up its governance frameworks, its climate strategy, and related goals and progress are important to stakeholders and investors. If nothing else, it's a proxy for operational excellence of management teams and boards, which in and of itself, I think is important to stakeholders. So aligning with TCFD made a lot of sense to me. I think where the challenges will emerge is perhaps where it overreaches a little bit as to that materiality concept, and then some feasibility concerns, right? So you think about, the attribution problem, whether a particular loss or potential loss is attributable to climate change, or is it attributable to just normal weather patterns or overpopulation, in a wildfire prone area, or poor land use planning. The SEC rules imply that we would have that level of granularity to ascertain what is attributable to climate change versus perhaps other factors that could also be contributing to the loss. And then they attach a very low threshold to disclosure. There's a 1% threshold for each financial line item. If you could foresee a financial impact of 1%, that triggers a disclosure obligation. To me, that's hard to argue materiality at that low a level. And then as I flip to kind of some of the emissions reporting, on scope 3, which would require that we disclose emissions of all of our customers and investees, there's massive data challenges associated with that. Our investees, our customers, they don't report this, by and large, report this information, but we have a small commercial book. Mom and pop shops aren't necessarily reporting that information. And so how do we get at that data in a reliable way to make that information meaningful? And so I think there's real issues with that. There's developing standards on how to measure emissions for scope 3 that are not fully mature and ripe, certainly on the underwriting side. And so again, to attach a disclosure obligation to something that has not fully developed, and then an attestation requirement on top of that, just adds a lot of potential exposure for insurers, and really I question whether it's decision useful information for investors.
Yeah, if I'm, if I were to put on I'm sitting in the SEC seat hat, I would say, well, the disclosure requirements the requirement will cause that disclosure to move forward. The ask itself is going to produce more data. And I think there are some cases where you can reasonably argue that that's the case, right? Disclosing where your stuff is physically located. To me, people aren't asking for it today. If you start asking for it, it will be produced. But I think we also need to be careful about where the ask itself will cause data to be produced when perhaps that data may not necessarily be meaningful. So I go back down to that resolution problem again. And this is an area that the insurance industry has a lot of experience thinking about this problem of what granularity of data is useful and meaningful, because we have to manage very large geographically distributed risks down to the location of individual buildings. So we bring some unique insights to this problem. But I think that sitting in sort of the large company side, and I think my peers who are in a similar position will make the same argument, is that there are immense numbers of climate data analytics providers that have sprung up partially in response to regulatory requests, offering to sell climate-related data in a packaged form so that you can say, I'm going to look at my book and it's going to produce a number. The problem with this environment is that, you know, there's a lot of churn and there are a lot of new players who are participating with, I would say, widely variable levels of expertise and knowledge in this area. And our ability to sort out who is producing useful information versus who is producing less useful information may not always be immediately apparent. Because remember, we're trying to make projections out in sort of the decade to 30 years time frame, which means that it may be a while before we can sort out who is producing good climate data and who is producing garbled nonsense data. There may not be an obvious mechanism for the market to correct for disinformation in the climate services space for some time. So we run the risk, if we don't have people who sort of can serve as this climate translator function, who understand sort of what is scientifically feasible and who understand sort of the impacts of the financial sector, we run the risk that we're going to generate this very large churn of data that is, in a sense, maladaptive. It causes us to make decisions that in some senses can make the risk worse because we don't have good information that's available at the table. So making the ask can help to foster innovation, but we also need to have some controls and guardrails in place to make sure that the ask is still within the realm of the feasible or the scientifically defensible today. I think there are some areas where it is certainly, you know, coastal flood, we can get down to a great level of granularity with reasonable sea level projections out to the timeframes that we're discussing out through 2050 or so. But our ability to get very granular information about, you know, regional changes in rainfall or extreme events like hurricanes is still very much developing science, and really still is at the cutting edge of the climate science community today.
No, I mean, that makes perfect sense, right? I mean, thinking about where do we need to align the ask with where valuable, accurate, real information can be acquired, and it can be evaluated and reviewed. But also, I think we have to think about it in terms of where we want to put bandwidth and where do we want to put focus and what is actually ultimately valuable, because chasing data for the sake of chasing data isn't a particularly valuable exercise for anybody. So as we think about what is it that, in the context of the SEC, what it is that investors should really need to know, what is material to their decisions. But then, you know, more broadly with other governmental agencies, as we review these disclosures for other regulatory purposes, solvency considerations, et cetera, what do we legitimately and realistically need to know? One of the things that I think you said, Dr. Harry, that is, I think, important, looks at how do disclosures requirements impact behavior. So how are they utilized to drive certain behaviors? And one of the concerns that sometimes is raised about climate-related disclosures, including the ones that are proposed by the SEC, has to do with what may be a focus on transition risk, and perhaps even a desire or an expectation that insurers will pivot away from certain kinds of industries, both in terms of investment in those industries and in insuring those industries and products. And you know, there's really quite a lot of conversation around, you know, does that pressure exist? Is that ever a good thing to pivot away in that way? What is the, you know, sort of the glide path with respect to this? I'm interested in hearing your thoughts on that issue.
Yeah, and we actually were confronted with this issue head on recently in the shareholder proposal arena, where we received a proposal effectively asking us to, you know, stop underwriting companies that engaged in any exploration for new fossil fuels. And so, despite the fact there's wide recognition that fossil fuel companies are high emitters and are contributing to climate change, I think it's important to understand that we don't have a turnkey solution as we sit here today. It's not a cold turkey approach doesn't work. The world's going to need energy. This is referred to as energy transition for a reason. So really, the notion of kind of choking off that industry or pivoting away meaningfully from that industry, not only is it unworkable, but it also, in my view, runs counter to an energy transition. The reality is those fossil fuel companies are going to have to be participants in this transition, and many are in the best position to impact that transition from an infrastructure perspective, from an expertise perspective, from a scale perspective. They have the greatest ability to influence outcomes in this arena. So, when we received that shareholder proposal, it offered us an opportunity to outline, what our commitment to energy transition means and how that would manifest, and how there are flaws in a divestiture-focused approach. And so we had actually recently declared for net zero by 2050, and it was really important for us to let our stakeholders know what that meant and what it did not mean. And for the Hartford, being a net zero company doesn't mean we're going to abandon hard to abate sectors. We're going to hold them accountable for progress, much like we're going to hold ourselves accountable for progress. But those companies, again, have to be participants, and kind of abandoning those sectors, in our view, is not going to help our society get to net zero. And it's not going to help the Hartford as we balance our climate goals with our other obligations to create value for our stakeholders. So, again, as we kind of navigate this energy transition and our kind of role in it, and how we interface with these fossil fuel companies, I think there has to be a recognition that they play perhaps one of the most significant roles in that transition. So,
I think it's also worth noting that we want to make sure that our good intentions do not drive unintended consequences as we push through towards the energy transition. So, for example, if you were to have two companies that are both producing fossil fuel related energy today, one of those companies is investing research and resources and people and talents into renewable energy sources. It's trying to transition its business model into something new and wants to be a major player in the new renewable energy economy. Then you have another company that is doing what it does really well, which is get oil out of the ground. If you say, insurance company, I am now not going to participate with either of these two companies, what you've essentially done is you have handed a competitive advantage to the company that's doing nothing, right? Because the company that's investing all of its resources into trying to do the right thing is not being recognized for trying to do the right thing. Now, is it easy to tell which companies are which? They're not necessarily. So, we're working with some partners to try to identify which companies have credible transition plans and which ones do not. But it shows that the easy answer of just divest from all parts of the economy that rely on fossil related energy would essentially require divesting from the economy. So we need to go at the energy transition with sort of a nuanced view that allows us to understand how our energy mix is going to change through time while holding accountable companies that are not doing enough. So I think we need to tread carefully in that area. Now, I do want to emphasize, though, that this is, again, an area where I think the insurance industry is uniquely well placed to look at sort of the flip side of the coin, right? So I think the reason why many of our disclosure requirements have been so focused on transition risk is because many of our disclosure requirements sort of stem from other parts of the financial sector where that kind of information is more readily available, when what insurance can uniquely bring to the table that perhaps other parts of the financial sector are not as well placed to assess is the climate adaptation part of the story. So there is climate change that is already here. It is affecting our risk today. We are seeing it impacting events today. There was a rapid response study in the aftermath of Hurricane Ian, which just hit Florida with devastating impacts, including a massive sort of inland flood footprint, arguing that hurricane-related rainfall in that storm was increased something like 10% as a result of climate change. Insurers are uniquely well placed to look at how climate risk can contribute to these major catastrophic events. And so the insights that we can offer on the change in hazard, and particularly how that change in hazard intersects with the built environment, are an area where I see that we need to step up and position ourselves in a leadership position that is a little bit different than our role on the mitigation side.
I want to, so just to respond, Kathleen, to you, and then to both Kelly and Terrence. So I want to stress a point about the securities laws in general that I think can be a bit muddled in debates about what this rule intended or didn't intend. And that is that, at least in the public company disclosure space, the SEC cannot itself regulate corporate conduct. And in this case, that kind of conduct which affects the environment. What the SEC cares about here, as with all public companies, is disclosure. Now, disclosure rules can certainly affect corporate conduct, but that's true for any securities disclosure rule. Terrence alluded to this, but I think the relevant inquiry about what is or is not the effect of these rules is to what do your investors want? So I hope companies are engaging with their investors about what their fossil fuel risk profile is on these issues and so forth on these issues, and the investors' expectation for companies' management of these risks. But I must say the SEC, the securities laws are agnostic as to a specific regulation of corporate conduct. They don't do that. What the SEC is doing is requiring disclosure, and that's the beginning and end of the SEC's involvement in this space.
And it'll be interesting to see how that disclosure plays out on company behavior. I think we already see some evidence where disclosure is causing sort of large energy companies to think about what parts of their portfolio of energy production they want to continue with and which parts that they want to leave off. I guess the dilemma comes in that because not all companies are required to disclose this information, we run the risk of sort of our highest transition risk properties, so sort of our most carbon intensive fossil fuels, going into parts of the private sector where SEC requirements are not necessarily required, and into companies that may be less well placed to take on the long-term responsibility and liability associated with those assets. So, you know, we need to be careful that, again, we don't cause sort of these unintentional dislocations. And, you know, there's not like a good answer to that problem, but I think it's worth just, yes, the rules themselves do not require any particular sort of emissions profile, but they can incentivize behavior that in some cases may increase or displace risk in ways that are hard to track.
Yeah, and Satyam, I totally agree with the notion of, you know, talking to your shareholders, and I guess that is what generally informs my view that TCFD is well aligned, right, with materiality, because we talk to our shareholders regularly, and you know, the types of feedback we get and the types of the lines of inquiry we get from them really do focus around things like governance strategy, and goals and risk management practices. So I think a disclosure framework that is centered around that, again, makes a lot of sense to me.
Well, you know, beyond governmental reporting, insurers also work with credit rating agencies, and credit rating agencies consider climate risk. So for today's discussion, I'd like to focus particularly on investments, and particularly on investments in infrastructure and adaptation. On the one hand, insurers have a unique perspective, skill set, and role to play in helping communities to identify and mitigate risk and to become more resilient, both as knowledge partners and as investors. But those may not be the best investments from a strictly financial perspective. So, you know, how do companies and rating agencies look at this issue, and sort of what could be an intersection, but also, contradicting points of view?
So I'm going to speak about how we see physical climate risks changing, the potential role of insurance in building resilience, and also some of the inherent challenges. So, first of all, it's really worth noting that, against this backdrop of an increasing focus on disclosure requirements and reporting by financial institutions, the vulnerability of assets, companies, and also countries, of course, to physical climate risks continues to grow. And really, as global emissions continue to rise, the physical impacts of climate change are increasing with each passing year. And really, to that end, our sustainable finance team, we published a report earlier this year where we assessed the potential losses linked to the physical impacts of climate change globally under different future warming scenarios. And our findings suggest that about 4% of global GDP annually would be at risk of losses by 2050 if current pledges to reduce greenhouse gas emissions are put in place and achieved. Now, to kind of put that into context, this is more than the downturn that we saw during the COVID-19 pandemic in 2020, when global GDP declined by about 3.3%. So, in other words, physical climate risks could represent a COVID. In other words, physical climate risks could represent a COVID plus event each year without efforts to adapt. And the research really also highlighted the wide divergence in countries' vulnerability to these risks worldwide, really with kind of lower and lower middle income countries set to experience GDP losses on average about 3.6 times greater than wealthier peers. And we found that South Asian countries faced GDP losses of about 15% by 2050 per year, compared to about 1% for European countries and about 4% in North America. And again, that's under this kind of current policies climate scenario, about 2.6, 2.7 degrees of warming by the end of the century. So, of course, that's missing this well below 2-degree objective of the Paris Agreement. So under warmer pathways, there could be more losses, greater losses. And of course, the challenge isn't some future risk. We're already seeing that the US is experiencing increasing exposure to climate hazards, particularly larger and also more costly events like storms, droughts, wildfires, and flooding now. And indeed, NOAA, the National Oceanic and Atmospheric Administration, suggests that severe storms, hurricanes, flooding, they've kind of combined led to over 3/4 of the billion-dollar climate hazards that we've seen since 1980. And to kind of hit home on this point about kind of geography a bit more, those billion-dollar events are occurring all over the country, all over the US, suggesting that kind of irrespective of where you are, most parts of the country are exposed to some type of climate hazard. And therefore, the challenge for the US and other countries indeed as well could be significant without concerted efforts to adapt and to build resilience. Now, at the same time, it's become widely acknowledged that there's a gap in terms of the amount of finance that's making its way into funding projects that help communities and companies adapt and build resilience to the projected kind of increase in physical climate risks. And against that backdrop of increasing exposure to physical risks that I've just described, this gap could really grow further still, and it really kind of demonstrates the need for additional investments in adaptation. Now, for the insurance sector, it's similarly trying to kind of grapple with how to manage these risks, those associated with climate change. And from my position, sitting in our sustainable finance team, it's clear that the insurance industry is really very well positioned, with its access to data, to expertise, to try and assess those evolving risks. And that really enables stakeholders, governments, companies, individuals to make better decisions. Suffice to say, the sophisticated kind of climate risk modeling capabilities available to insurers can really help provide unique insights into policyholders' exposure. What we're also seeing is, property reinsurance also plays an important role in kind of building economic and financial resilience for those loss-affected policyholders after those loss events. And many reinsurers are actively looking to develop new products to kind of help them address this large and growing proportion of society that is underinsured. And you may have kind of heard that referred to as this kind of disaster protection gap. Now, that said, as losses from physical climate risks increase, insurers are likely going to react by raising prices or reducing their exposure. And we've already observed examples of both of those strategies in the US in recent years. And of course, suffice to say, higher insurance premiums or risks that are uninsurable may lead to a widening of this protection gap that I've just described. Now, the final point that I wanted to make really is kind of centered around some of the challenges. We know that physical climate risks are an exposure to those risks is kind of getting worse, but there are some challenges in kind of how we assess the exposure of assets of companies to those risks. And really, while we've been learning more about the physical impacts of climate change, including where and when impacts may occur, and we've got a bit more clarity about what some of the associated costs might be, there are challenges facing insurers, including those particularly associated with data, uncertainty, standardization of data sets, terminologies, etc., and also disclosures. And that really affects insurers' ability to leverage their core functions to address this adaptation gap. And many of those challenges, they can come in different forms, of course, but principally uncertainty is one of the main ones, and that really serves to kind of add to the complexity of the challenge. So when we think about adaptation, we're thinking about how some of these impacts may play out. The timing when these impacts will play out, but also the geographic scales over which climate hazards and their impacts play out are also quite relevant. At the same time, we have limited availability of data on the kind of effectiveness of adaptation measures. That's a relatively unknown. We're still gathering data. So some adaptation measures, like a seawall, for example, that may be protecting an airport against sea level rise or storm surge, that's likely to be extremely effective. However, the effectiveness rather of other measures, like initiatives that involve multiple actors, or those that take place over a long period of time, the benefits of those measures may be less clear, and they could play out over time. One of the last point on some of the kind of uncertainties, I think, relates to standardization. I mentioned terminologies of data, but and also the kind of complexities more generally of kind of climate science. There are many different climate models, there are many different climate variables, and there's also an increasing number of data sets. However, there really is limited standardization between them, like the terminologies that are used, the data quality thresholds that are applied, and a defined set of use cases. How should you use this data for particular types of assets in different parts of the world? And the result, of course, is that uncertainty, and specifically the comparability of outcomes, is a growing challenge for the sector. That said, the increasing focus on standards and disclosures is trying to address this issue, but we know when it comes to adaptation, that adaptation tends to be context and place specific. So, it matters what you are and where you are, and therefore the interventions and the strategies that are needed are oftentimes unique, making the comparability within and across portfolios, across assets, a real challenge. Now, I'm conscious of kind of ending on a somewhat kind of negative note. So, I wanted to say that it's worth recognizing that there's been significant progress in this space, in recent years, understanding kind of risks and what we can do about them. And I recall a paper from a couple of years ago that counted about 370 or so climate data providers just in the EU alone. So there's more data than ever before. And with that context, while no perfect solution exists to how we might resolve the financial impacts of physical climate risks, this shouldn't be an excuse for inaction. And what is clear is that collaboration is necessary to kind of tackle these, in many cases, shared risks, and that the insurance industry will be a real key voice in that discussion. So I'm often asked, there's a growing interest in assessing and understanding the exposure of assets and companies to climate hazards, as well as disclosing any related metrics. And that brings with it some potential challenges and also some potentially, unintended consequences. And there are associated risks with that. And really, we've seen a lot in the literature, particularly quite recently, actually, in the last few months, commentators suggesting that the kind of rapid and in many cases unsupervised uptake of climate risk data could lead to a number of challenges. And what that literature is saying is that there's potential for unintended misuse in the context of financial decision making and disclosures if you're using data and not really understanding some of the uncertainties and some of the challenges associated with it, some of the assumptions. There could be misplaced confidence in the assessments of climate risks, and an increase in vulnerability of an entity to climate risks, where a particular assessment has said there may be low or no risk. There could also be resulting material misstatements in financial reports, and of course the associated potential for litigation, irrespective of the fact whether this is kind of an unintended misstatement, of course. And also maladaptation. We don't tend to talk about maladaptation very much, but maladaptation is really where adaptation backfires, and it really kind of serves to increase rather than decrease the vulnerability of an asset or in a company. And particularly in the case of long-term capital investments in infrastructure, which typically have operational lifetimes of multiple decades in many cases, maladaptation is a real risk, and there's a possibility that we could be setting ourselves up for even greater challenges in the future.
From a company perspective, I think we think about investing in two ways. One, we think about strategic investment in a way that better enables the Hartford to participate in the opportunities that global energy transition will create. And then we think about, just pure play financial investing in infrastructure and other green energy initiatives. And really, we view both as playing a role in helping communities identify and mitigate climate risk, and both can support value creation. And we don't view those objectives as mutually exclusive in every instance. So, we approach the issue both from an underwriting perspective and an investment perspective. On the underwriting side, we're looking at constantly assessing our product portfolio and how we can invest in creating product enhancements and or new products. Whether that means investing in people and expertise or data or partnerships. We do think there's an opportunity for those who spend the time and allocate the resource to that type of investment for companies to reap the rewards as the moment arrives. We've got, obviously, with the Inflation Reduction Act, $370 billion worth of green energy initiatives and infrastructure earmarked, right? And those initiatives are going to need insurance, and they're going to need the expertise behind risk selection and investment. And so in our view on that side, it's an exciting time to be thinking about the possibilities. On the pure investment side, last year we announced a $2.5 billion commitment to investing in clean energy initiatives. All indications from our investment team are as we're tracking ahead of schedule in that investment commitment. And to me, that signals that there's opportunities out there. And as we look at those opportunities, we're not just investing in climate or ESG related companies or technologies because it's the right thing to do. They have to meet our internal investment hurdles, right? And it's not again investing because it improves reputation or other dynamics. It has to produce returns. There has to be something in the investment thesis beyond this feels like the right thing to do. We're finding those opportunities. And again, I think with the Inflation Reduction Act, that those opportunities are only going to increase. But again, as we look at the investment side, we're making financial and strategic investments where it makes sense to do that. And again, believe there's opportunities out there.
And again, I think this is a place where climate risk, I think, takes a more holistic and systems level view to be able to assess risk within your portfolio as well as identify opportunities. So within Liberty, we consider climate, or we consider infrastructure risk, to be a climate risk multiplier. So that means that it doesn't necessarily matter what sorts of disasters are impacting our portfolio. Weaknesses in our critical infrastructure will enhance those losses. And we've seen that over and over again in recent events, whether it's power grid failures associated with the Texas freeze event, or hurricanes Fiona or Ida that have just also caused massive power outages. Those exacerbate any existing losses and make them bigger. They make sort of the business interruption bigger, they make the larger economic impacts bigger. And unfortunately, it's an area where, as an insurer, we don't, although we pay the bills that are associated with those infrastructure failures, we may not have a very direct way to identify, hey, this is something that is going to cause an exacerbation of our risk, and we don't really have a lot of influence on the decisions that are being made there. My favorite example of this is after the Texas freeze event. The following year, there was another cold snap, and the Texas power grid very proudly showed that they were winterizing their facilities by wrapping them in saran wrap and duct tape, as that was going to help to make sure that they didn't freeze this time around and cause the billions of dollars of pipe burst damage that the insurance industry paid for. So being able to identify where those risks can happen can help us think about risk, not just at the single policy level, which is where insurance has traditionally been strong, but scaling that up to the community level. And we want to make sure that, because of the fact that climate risk is a new challenge that's different in scale than many of the hazards that we've dealt with in the past, that we can identify where there are trade-offs between individual risk reduction and community scale risk reduction. So for example, you might decide that, if you're a homeowner and you are at risk of flooding, you may decide that it's worth the investment to raise your home up on stilts so that it's above base flood elevation, and you've reduced your flood insurance premiums, which is wonderful. It'll reduce your risk of your home for the long haul. The problem is, what happens to the 2,000 of your other neighbors who are at exactly the same level of flood risk, who now haven't had any risk reduction done for them? Raising your home is expensive, it's individual resilience, and it costs a lot of money. How can we identify the point where it no longer makes sense to do sort of individual resilience, but maybe it's time to invest in a seawall or a levee to reduce the risk for the entire community? So I think being able to proactively identify where those trade-offs can potentially happen and communicate those out to communities is an area, again, where I think the insurance industry is uniquely well placed, but needs to be a part of our climate risk management conversation and shows the critical role that infrastructure can play. So we need to not think of it as just what's the investment of this, one single piece of infrastructure, but rather how does that infrastructure serve as a risk mitigator for its entire community.
And in that broader context, making sure that as those sort of more community-based infrastructure investments are being made in the broader picture, that they don't have the unintended consequence of sort of a negative impact, on a company's credit rating. So how do we look at that more holistically so that we are incentivizing the right behavior while at the same time, being responsible about credit and financial risk?
And I think there's some real opportunities for sort of public-private partnerships here as well, because you can imagine if you're trying to, fund a municipal bond to fund a piece of infrastructure, there is the value of that piece of infrastructure as an investment. But think about, for the municipality, what is the value that that infrastructure is providing in protecting, say, its property tax base to make sure that those future investments can continue to be made? So I don't think we've done a really good job so far of communicating not just, the one-off investment opportunity, but rather the holistic view of pairing, is this a sound investment sort of from a, sort of traditional view, as well as the value that it brings in economic stability for an entire region and climate-related risk reduction.
So let me step back into, I guess, the reporting world again. Companies are in the business of staying in business. And for large, sophisticated companies like those that are represented on this panel, tremendous focus has been placed on understanding the risks related to climate and weather events that are evolving. So, from your perspective, what information in what format is important to know for investors, for rating agencies, and for regulators?
Yeah, so at the risk of beating a dead horse, I'm gonna again focus in on what I think is working well today, and that, in my view, is TCFD's kind of four-pronged approach around climate risk management, climate governance, climate strategy, and then goals. I do think SASB offers more of a quantitative and a accounting-oriented overlay to some of those themes, and goes a bit beyond that I do think provides some useful information. But again, companies that are not engaged in substantive efforts around those four pillars may find themselves at higher risk, both in terms of direct exposure and lost opportunity. As investors and other stakeholders look at the long-term prospects of that company. So, you think about risk management. Insurers insure against weather-related events. So, as weather-related events become more severe, I would think stakeholders would want to understand how we identify, assess, and mitigate risk. To me, that seems like table stakes, how our risk selection and modeling and pricing and limits work in that regard. On the governance side, you think about how we're set up internally to identify both risks and as importantly, opportunities to participate in energy transition. And then strategy, how are we building out products? What's our invest agenda? Both in internal invest and invest in green initiatives or securities. I think, again, that provides useful information to investors. Finally, targets and metrics. How are we holding ourselves accountable for progress? That to me feels very much in line with traditional notions of materiality. And again, I mentioned it earlier, it can be, if you are performing in these areas, that could be a proxy for operational excellence of your management teams and boards, which again, in most stakeholders, I think that would qualify as very important information. So again, I do think the SEC pulls some of those pillars in, and I think that's a good thing. But to the extent the concerns arise, it's around kind of extending beyond those traditional notions of materiality, and then creating kind of practical concerns around the ability to provide reliable and decision useful data.
Yeah, I think it's actually kind of instructive to look at the history of catastrophe modeling within the insurance industry to understand how physical related hazards were incorporated into insurers' book of business, because prior to the advent of these tools, we essentially used sort of actuarial tools that used history and curve fitting essentially to try and predict what losses could be. And it eventually became clear that that was no longer sufficient. But when we initially started putting together these tools, we didn't have a lot of granular information. The amount of information that we had actually looked a lot like what things look like in our investment space today, where we didn't have a lot of geographic detail. We didn't necessarily know which perils different things were exposed to. Maybe you had state level information or county level information, which honestly is even more than we have on the investment side. So I think being able to identify where granular information about our actual built environment, because really the built environment is how we will experience many of these climate related changes in hazard, I think is an important step, and something that can be help to break through some of the barriers in analytics that exist today. But there's one other piece that so far doesn't exist on the investment side, and it's related to this lack of granularity information. But I think it's worth calling out because, again, I think this catastrophe model example is instructive, because the catastrophe model includes a couple of different pieces. There is the hazard itself, which is what we're working on in the climate modeling space, and there's a lot of work to be done there. There's the exposure, which is what I'm talking about, of knowing where your stuff actually is and some basic characteristics about it. But those relate to each other through a vulnerability function. So how does hazard produce impacts to your book of business? And in the investment space, that vulnerability piece is incredibly underdeveloped. What climate impacts will cause an effect on your investments, whether it's through business interruption, whether it's through your stock prices, whether it's through your risk of defaults on municipal bonds. We don't have a great relationship today between where your investments actually are and how climate affects them directly. And you can only begin to build that out by knowing a little bit more information about those, where those risks are and some characteristics about them. So I want to call out that particular function, that vulnerability, how climate-related risk actually plays out in the balance books of companies, as something that we don't understand all that well today, and that we're trying to explore. And I think there's some real opportunities. Some of it may come out in the SEC disclosures. Some of it's coming out in the TCFD reporting that we're doing now, because TCFD is really focused on how you can incorporate climate risk into your strategy. How can you can incorporate it into decision making? So thinking about climate risk from the framework of how much climate risk would I need to see in this particular area for it to affect my decision, for it to affect my risk appetite, essentially a reverse stress test within your own book of business rather than a prospective, this is what I think is going to happen in 2050, can help to make that climate risk much more actionable when it's sitting within companies and therefore more valuable to disclose from the perspective of investors.
I think what at the highest possible level, when you're sitting at the SEC and you're developing a rule like this, what you're ultimately trying to achieve is the dissemination of consistent, comparable, reliable information relating to climate risk. Of course, there's voluntary information today, but it has not achieved that core purpose. And there's a lot that goes into that. There's enforcement, there's auditing, there's assurance, and so I don't want to lose sight of the fact that that is a complex undertaking and multifaceted undertaking, but that's ultimately what investors have been asking for in this space. So in terms of format, most SEC rules traditionally have been a combination of qualitative information, qualitative disclosure, and quantitative metrics, most public company disclosure rules. And there's plenty of speculation as to what would happen in the final rule for climate. But I'd broadly expect that kind of mix of qualitative and quantitative information to continue under this SEC as they continue to develop rules in the sustainability space. Now, you might ask the more difficult question, which is what specific metrics can and should be required? And to that, I would say that's a question that's actively being debated by the staff of the SEC right now as they respond and review over 10,000 comments and move toward finalizing this rule. So the market feedback that you received during the request for information and during the proposed rule itself right now is going to be really critical as the SEC figures out what works, what doesn't work. And so that's that responding to what the market tells us is can be done or cannot be done or is costly or vice versa is what the bread and butter of the SEC staff do, and that's what they're doing right now.
And I think that what you've described, and certainly at the NAIC as we developed the revised disclosure form, climate disclosure survey, that is an incredibly important element. That sharing of information and really using the process to become better educated, whether at what phase you do that, whether it's before you release the initial or while you're evaluating those. Because I think this really in every area of insurance, but particularly with respect to this because of the breadth of it, it's so important that we be guided by the science and what is possible and what is usable. And I think that this exercise will hopefully be an educational exercise, not just for the SEC, but for really all regulators that are looking at this issue, whether it's purely from an investor's disclosure standpoint or other disclosure standpoints. Because I certainly have found just in the process of this session and our preparation of this session, tremendous amount of very useful information that goes well beyond sort of just the focus on the SEC's focus. So with that, I really want to thank everybody for the discussion today. I know we could go on for a really long time. We have only 45 minutes and what could be a minimum of 45-day discussion on these critical issues. So thank you again for each of our panel members, and thank you for the audience for being with us today.